Okay, I think we're online. So let's get started. Hopefully we have an audience out there. I can't tell because I can't see them. But this is session number 18 in the parallel sessions 3. The title of the session, Empirical Research on the Conduct of Monetary Policy, is a session that Mike Owyang and I of the Federal Reserve Bank of St. Louis co-organized. So we will start and go in the order of the program. So the first paper is Hawks versus Doves versus Rules versus Discretion by Klodiana Istrefi of the Banque of France. So Klodiana, I'll turn the program over to you and take it away.
Thank you very much. So this is a joint work with Alex Nikolsko-Rzhevskyy, David at Lehigh University, David Papell and Ruxandra Prodan at University of Houston. The conduct of monetary policy is often characterized by the hawk versus dove debate or rules versus discretion debate. And we are going to provide a metric to show whether the economic performance is better under hawks versus doves or rules versus discretion, or combination of the four. And I'm going to start with a short motivation or introduction of these debates. We think of a hawk as a central banker who is more concerned with inflation, and a dove, a central banker who is more concerned with unemployment. Is the society better off by having a hawkish central banker or a dovish central banker? Rogov asked this question in 1985, arguing that actually the society is better off by appointing a conservative central banker, which nowadays we call hawks. And a conservative central banker is a central banker that is more concerned than the society with inflation relative to unemployment. And by appointing such a central banker, we avoid this, or we lower this inflation bias and avoid the time inconsistency problem. The Fed has a dual mandate, which implies concern for both inflation and unemployment. And recent speeches by top Fed officials in the past and the current seem to suggest that the dual mandate actually implies an equal concern. However, monetary policy in the US is decided by a committee, and the committee members we have observed seem to have different weights or to lean differently to the dual mandate. Therefore, this debate of hawks versus doves exists. The rule versus discretion debate is somehow older debate, starting with Friedman in 1959, suggesting a constant policy, constant rule for money growth versus a discretionary management of money growth. And later we have the Kidland and Prescott suggesting or arguing for pre-commitment to a rule. Nowadays the discussion is more policy rules versus constrained discretion. So we have Taylor, let's say, versus Bernanke, where constrained discretion is the policy is more flexible. However, there is a strong commitment to the objective. When seeing these two debates together, hawks versus doves receives a lot of media attention. So the media is always interested, or market participants, who is going to be the Fed chair, is the hawk, is the dove, who is nominated for the board, what are the policy preferences, is the new rotation of Fed presidents going to rock the boat, how are they going to vote, and there's not as much research. But the other discussion or debate, rules versus discretion, has not so much media attention, but there is much more research. And one can wonder now that central banks have more clear objectives, have numerical objectives, use monetary policy rules in their policy deliberation. Should we worry about these debates? Are these old debates or not? Well, the more recent revision of the statements on longer run goals and monetary policy strategy that was introduced last week by Jeremy Powell Jerome Powell, actually there we see that there is a move towards discretion, and we see that there is also a tolerance for inflation above 2%. So it seems that these debates of hawks versus doves and rules versus discretion, I think they will be still part of the debate. So what we do in this paper is we evaluate economic performance in hawkish versus dovish periods, rules versus discretion periods, and the combination of the four using a metric that is by evaluating quadratic loss functions that minimize inflation loss and unemployment loss. And then we look at loss ratios at different regimes, let's say at hawkish versus dovish periods, and we evaluate them at a policy lag, 4, 6, and 8 quarters, with two purposes in mind. One, that policy takes lags. So monetary policy has some lags to give the effect in the economy. And the other reason is to avoid the reverse causation. Imagine being in a good state of economy, maybe it's easier to follow a rule when the economy is doing well. So we have these policy lags to kind of avoid with these situations. We look at the economy during 1965-2015. We have quarterly data frequency. We stop at 2015, constrained by the data that we have on hawks versus doves. So as a preview, a very short, quick preview of the results, we find that there is strong evidence for rules versus discretion in terms of economic performance, and the evidence for hawks versus doves is not as strong, so it's weak evidence. And the best performance is when we have a combination of hawks and rules. So we have low deviations from a typical rule, and we will discuss several rules. These are results for the whole period, 65 to 2015, but if we leave out the great inflation period, then the results actually are stronger in favor of hawks versus doves, and not so strong about rules versus discretion. So I guess you're curious, how do we measure hawks and doves? Hawks and doves is a measure that I have quantified in previous research. I have a measure that quantifies the policy preferences of each FOMC member that have served in the FOMC from 1960 to 2015. There have been 130 members, and have characterized as hawks and doves 93% of these members. How I did that, I have used a newspaper, a financial media coverage as a source of information of how these members are perceived to lean towards the dual mandate of the Federal Reserve. And by looking in real time at the news in the 60s, in the 70s, in the 80s, and so on, I've noticed that several of these members, the majority, are perceived to be as consistent hawks or consistent doves over the time that they served at the FOMC. But some are perceived to switch camps, and what I call in switching preferences or swingers. Now we have individual FOMC members and hawks and doves, and the idea is to go to the aggregate FOMC level to aggregate these preferences. We work with a hawk and dove balance, which is the number of hawks in the FOMC minus the number of doves. And I'm dealing here only with the voting members, so maximum there are 12. And the idea is that if we have a hawkish FOMC, if the balance is positive. But when we're aggregating the preferences of the FOMC, we have to take a stance on the role of the Fed chair, the preference of the Fed chair. We know that the Fed chair has the same vote, so it's one vote among the 12 members. However, the Fed chair might have a stronger power in policy by being by setting the agenda, and second, by being a consensus builder. We have several Fed chairs in our samples, starting with Martin, Burns, Miller, Volcker, Greenspan, Bernanke. And as you know, these are very different personalities. They have been seen as different in how they conduct their meetings, some to be more autocratic, some more collegial. So we cannot really assign a specific to each of a specific weight to each of these different chairmen. So what we do is we work with weights. We have a Hawk-Dove balance, which is the sum of the preference of the Fed chair and the sum of the Hawk and Dove balance of the rest of the members. So, and we check for different weights. The 0.5 weight is the Fed chair preference has equal weight as any other FOMC member, and the weight of 1, the policy preference of the Fed chair matters. So the Hawk and Dove balance is decided by the chair, the preference of the chair. The other issue is that the way that I have constructed the measure by looking at perceptions about these members, this perception could be affected by the economic conditions. So if there is times of great inflation, we see more members coming out there and saying inflation is our #1 problem. So the idea is to clean this measure from the state of the economy. And to do that, we have regressed the Hawk and Dove measure on inflation and unemployment as known in real time, taken the residual, and then we work with this measure as our Hawk and Dove balance. So we have hawkish majorities if this balance is bigger than 0, and dovish majorities if it's smaller than 0. We also look at an alternative when we look at strong hawkish majorities versus strong doves and weaker majorities when, for example, if we are in a situation of 10-2, this could be considered as a strong hawkish majority versus at a situation where we have 7 hawks and 5 doves, this could be a weaker majority. How do we evaluate the economic performance? As I mentioned, we have these quadratic loss functions that we want to minimize these loss functions, the inflation loss and the unemployment loss. We work with the revised data in this case because we want how the economy performed with our knowledge of the economy, let's say ex post, not what Fed knew in real time. We look at loss ratios for each Fed chair weight. We look at the average loss in hawkish periods divided by the average loss in dovish periods. And as I said, we evaluate these losses in different policy lags. Just before the results, this is 2 graphs depicting this Hawk and Dove balance. Look at the second graph, which is the Hawk and Dove balance, where we assign the whole, let's say, a weight on the preference of the Fed chair. It's easier to see. The dark areas are the areas where the Fed chair has a hawkish preference, so we have a hawkish balance, and the white areas are the ones with a dovish, when we have a dovish majority, let's say, according to this measure. So the hawkish areas correspond to Martin. We start in 65, so it's like the 5 years of Chairman Martin. Burns has some hawkish and dovish periods depending on the state of the economy. If we don't control for the state of the economy, Burns in my sample is a hawk. Then we have Greenspan as a Volcker as a hawk, and Greenspan partially hawk and dove depending on the periods. When we look at the top chart, then this is when the weight of each member is equal, so the Fed chair gets equal weight, and you see that then dovish and hawkish periods are distributed differently. Now this is the main, let's say, type of table that you will see in this presentation. We have here in red, these are the loss functions with equal weights on inflation and unemployment loss. And these are the data for the hawk in red, in dove for blue, and hawk and dove is the loss ratio. We have calculated this for here I'm showing only the two cases where the Fed chair preference is equal to the other members. So we have this A equals 0.5, and the Fed chair preference has the whole weight. What we observed that the red numbers are consistently lower than the blue number, except the policy lag 8 quarters. When the preference of the Fed chair is equal to the others, suggesting that the losses are lower under hawkish periods than dovish periods. This is also observed in the loss on the loss ratio. However, when we test for the significance of let's say the loss ratio being different from 1, we don't find support that these losses are different in hawkish and dovish period. These results, however, are really strong when we look at strong hawks versus strong doves and these weak majorities. Then we have a more stronger result that the economy is performing better under strong hawks and then strong doves, and these two cases are preferred to an uncertain or a weak majorities. One can relate this to the literature on monetary policy uncertainty, where, as we know, uncertainty about monetary policy, being who's the policymaker or what policies they will conduct, actually it's deteriorating. It's bad for the economy. Now let's go to the discussion of rules versus discretion. We will look at 3 rules. The Taylor rule, which we call the balance rule, with equal weights on inflation and output gap, output gap tilting rule with a higher weight on the output gap, and inflation gap tilting rule with a higher weight on the inflation gap. And these are calibrated rules. These are not estimated. These are rules that are used by the FOMC in the deliberation, and these are published in the monetary policy report. What we get from these rules is the deviations, which is the actual Fed funds rates minus the prescribed rate from one of the rules. We take the absolute value, and the idea is now to come up with low deviation periods and high deviation periods from this rule. In previous paper, my co-authors have used different ways to categorize low deviation periods and high deviation periods. In the current paper, it's a very simple approach. We are going to rank them from highest to lowest, and we're going to get the median as the cutoff point. And this is to approximate the hawk versus doves periods, which really divides the sample that we have in half. When working with rules, we work with real-time data. So there are a lot of little details about the data, what is the policy rate, the shadow, and so on. So I will avoid this because we don't have much time. But you can ask if you have questions. So this is a graph that shows the deviations from the balanced Taylor rule when we have 0.5, 0.5. The shaded area are the high deviation periods, and the white area are the low deviation periods. As you see, the high deviation periods correspond mostly to the great inflation, and the low deviation, we have this great moderation after 1985 to the beginning of the 2000s. Again, we are going to evaluate the quadratic loss functions and the loss ratios for each given policy rule. We are going to estimate the average loss in high deviation periods divided by the average loss in low deviation periods. Now with rules, there is two things to consider. A loss ratio bigger than 1 is a minimal criteria for a good rule, and the higher loss ratio is better. What the idea here is that a good rule is a rule that is costly to deviate from it. So this is the general idea. Here is the table that shows the results. So we call discretionary the high deviation periods, and rule-based the low deviation periods. For the original Taylor rule, the output gap tilted and the inflation gap tilted rule. Now, what you should just notice immediately, because the table is big, is that the red numbers are bigger than the blue numbers, meaning that the losses under discretionary periods are consistently higher than under the rule-based periods. And the loss ratios as well display this result, and these results are statistically significant. So economic performance is a strong evidence that economic performance is better under rule-based than discretionary period. Now let's combine all these cases together. We have hawk and high deviation periods and hawks, high deviations and dove, low and hawk, low and dove. And we're going to look this for loss functions that put equal weight on inflation and unemployment loss. And we have same weight on the preference of the Fed chair with the other members. For the three—
5 minutes.
Okay.
5 minutes, Claudia.
Okay, for the three rules as discussed before. Here as well, just as a simple way to see the results, look at red versus blue. And those reds in bold is the best case where the losses are minimized, which correspond with low deviation periods and hawkish periods. So it's a combination of the two who gives smaller losses in this quadratic loss function. And this is the case for the original Taylor rule, for the output gap tilted Taylor rule, for different policy lags. Only for the inflation gap tilted rule, we have that for policy lag at 6 and 8 quarters, the low and dove is let's say, the best combination. But what we see that the low and hawk is the best combination, but the high and hawk is the worst combination for the economic performance. And in the fifth column, we have the loss ratio of low and hawk versus the other combinations, which these loss ratios are smaller than 1, and they are statistically significant. So we did some robustness check. We looked at different weights in the loss function, because the results that I show here, they give equal weight. So it's the society, let's say the social loss function with equal weight on inflation loss and unemployment loss. We did different weights and the results are similar. We looked at different periods. We removed the great inflation. When we remove this period, then the results are more in favor of hawkish to dovish than to rule versus discretion debate. And when we remove the great recession, more in favor of the rules. It's actually it's the great inflation that makes the difference. So to conclude, we evaluated economic performance under different regimes, hawks versus doves versus rules versus discretion. For the whole sample, we find strong evidence for rules versus discretion, but weaker evidence for hawks versus doves, with the best performance in a combination of hawks and low deviations. And before I finish, I just want to give 2 caveats and maybe get your feedbacks or your suggestions, because in this, what we have done so far, hawks and doves and rules and discretion periods are treated as independent. It could be that maybe hawks tend to implement a rule-based policy, or doves to be more discretionary. So we don't know that, and we have not checked, or at least at the moment, we don't know how to let's say, interlink these two. So, and if yes, if hawks tend to implement a rule-based policy, which rule do they implement? Then I want to, again, to stress that we have dealt here with the social loss function and not with the Fed loss function. And we have assumed constant weights over time. And society maybe has the same loss function over time, or maybe it's changing. I don't know. So this is something that we didn't deal in it. I don't know if you think it's important. And just to mention that the loss function of the Fed might have had different and varying weights over time, depending on this discussion of who's the policymaker, were they on the hawks or the doves, depending on the turnover, on the rotation of voting rights, and so on. And here I conclude.
Okay, thank you, Klodiana, and thank you for being right on time. So we do have time for questions for Klodiana, either from the panelists or the audience. I'm not sure how the audience can ask them, but if they can get into the chat and pose them there in written form, that would be one way. But I open up the floor. I do have a question, Klodiana, on your last point. In thinking about your quadratic loss function, putting, and you've experimented with different weights on unemployment versus inflation, but you have imposed symmetry on the specific variables. For example, if you're treating unemployment below U star as equivalent to unemployment above U star. As you may have noticed in the Fed's new statement that came out just this week, they replaced the word symmetry with shortfalls.
Yes.
And suggesting that they care more about unemployment that is above some measure of U star than they would unemployment that's below U star. So that would be certainly an example where they might have a different loss function today than they had a week ago.
Yes.
But in general, it's questionable, I think, whether the Fed would have treated unemployment above U star symmetrically with unemployment below U star. So that would be a question if that's something that you could think about in terms of what you're doing.
Yes. So actually, this is important, but as I mentioned in this, just to emphasize in this caveat that when we looked at the loss functions, we dealt with the social loss function, society's loss function, and we don't know how actually what society cares more about deviations, or maybe the society as well cares about the shortfalls. So
right.
That is the assumption of what society cares.
Right, and I'm not sure the society would care about
yes
low unemployment as they would high unemployment.
Yeah, I agree.
If I may, I just had one other question, then I'll stop monopolizing. And that, thinking about the characterization of hawks versus doves among central bankers. My boss, Jim Bullard, came in, it was always thought to be a hawk, and he would describe himself as an inflation hawk, but yet he was advocating among the most loose monetary policy in the last 5 years or so. So I wonder if that has to do more with characterizing their views about the Phillips curve. So Jim doesn't ascribe much weight, if any, to the Phillips curve, and so he was just looking at inflation shortfalls, and maybe he's putting more weight on inflation shortfalls than he was on unemployment. But I guess I'm having trouble separating the characterization of hawks and doves versus just views about the Phillips curve.
Yes, yeah, I agree. So I've noticed, so this exercise is from the 60s to 2015. And I stopped with Bullard being a hawk. So in my sample until then, so he's a hawk, and probably if I continue, he would have been a swinger like Coach Lakota. But I have as well noticed that when at different times, people may be categorized as switching camps for different reasons. So I have the members in the 70s that switched camp from hawk to dove, and that because inflation became a problem. Then I have members in the 90s where probably the inflation was not a problem, but I still see that there are swings from doves to hawks. But what happened in the 90s is the idea of inflation targeting. In New Zealand, Bank of Canada introduced inflation targeting, and the US and the Federal Reserve was as well quite demanded by the Congress and the people to are they thinking about inflation targeting and to remove inflation from the equation. And a lot of FOMC members came in this period to say, yes, we should remove inflation from the equation, maybe go to a zero inflation target. And so this is a point where some doves moved to hawks because they were doing a lot of lip service to inflation, but not because the situation was bad with inflation, just there was a different understanding of of the economy or frameworks. And the idea as well with Greenspan that came later in the middle of the mid-90s, saying that there is high productivity that will not lead to inflation. This was another that he moved from hawk to dove, at least in the perceptions of the markets. That as well because he thought that there is a different type of the economy. So Bullard, I don't know if it is a different type of economy or but yes, he changed his mind, but I don't know about economic understanding or economic theory, or I don't know how.
We have time for another question or so for Klodiana.
I can ask one question if you have a minute. So your definition of discretion is just if you don't follow sort of the Taylor rule or a balanced Taylor rule. And during the zero lower bound period, it's sort of hard to follow a Taylor rule. And I didn't think they were particularly discretionary. I mean, they were laying out different rules of how they were going to act. And so I know you did robustness where you consider excluding the period entirely, but it's, it just raises the question, I mean, maybe they were following a Taylor rule in some earlier periods, but the coefficients were different, or maybe, it's possible that, your definition of discretion might change if you sort of change the rule over time.
Yes, and to deal actually with the zero lower bound or the forward guidance period, in that period, because Fed fund rates was not moving, we're working with a shadow rate, which is supposed to kind of reflect the loose monetary policy that was coming from other measures like quantitative easing. So while the Taylor rule in that period was actually suggesting negative rates, the Fed funds rate didn't go below zero, but the shadow rate it's negative. So in a sense, we use the shadow rate for that period in the rule. But I agree that the rules have changed and we have considered constant rates.
I'm going to have to stop you there, and so we can go on to the next paper and stay on time. Thank you, Klodiana.
Thank you.
The next paper is Mike Owyang. Mike, if you get your slides up. Revisiting the Fed's forecast advantage. Mike Owyang with co-authors. So Mike, take it away.
Okay. So this is joint work with Amy Guisinger, who's at Lafayette, and Mike McCracken, who's my colleague at the Fed. The disclaimer applies to this that doesn't represent the views of the system or the bank. Also, I would like to remind Dave that his comments about Jim don't reflect the views of the bank either during his questioning. So ignore the date. The dates are all lost in the middle of the pandemic. So what we're doing here about the Fed's revisiting the Fed's forecast advantage in the context of whether or not the Fed has more information about how to make forecasts. And so this will have some implications for macro, which we're still currently working on. So this paper is sort of divided into three sections, one in which we're going to look at whether or not the Fed has the forecast advantage still, what that forecast advantage is coming from, and then the macro implications of that, of what we're concluding. And so that's sort of still in progress, so comments would be welcome on that. Okay, so to get started, the Green Book is a component of policy making. It's now called the Teal Book. So academics have spent a bunch of time comparing Green Book to private sector forecasts, the SPF, the blue chip, and they basically come up with two things. So one is that the Federal Reserve's forecasts dominate private sector forecasts, particularly for inflation and particularly for the early period, which leads to the second stylized fact, which is that sort of more recent studies have found that the Fed's forecast advantage is eroding. So they don't quite have the same informational advantage that they did prior to, say, the 1990s. Right? So one of the things that we thought about was that the Green Book forecasts are made conditional on a policy path. So the Fed is forecasting H period ahead inflation based on an information set omega at time t, right? And also a path for policy. So RT plus K, where K is potentially more or less than H. Okay. The private sector, though, doesn't have the conditioning path, so it has to forecast the Fed in addition to forecasting, say, inflation. So it's trying to form a probability density over H period ahead inflation and the Fed's policy path conditional on other information that has it. Okay, so in this sense, the Fed may have an informational advantage when it constructs the forecast, depending on whether or not its conditioning path is the realized path. Okay, so we're going to ask the question, does the Fed's apparent informational advantage result from its knowledge of the conditioning path? And what we're going to do is we're going to take two approaches to try to equalize the Fed's and the private sector's information set. Okay, so one thing we're going to do is we're going to develop a conditional encompassing test. So to test for equal information, what you would tend to do is run a traditional conventional encompassing test. We're going to augment this conventional encompassing test with IV in order to compare the Fed's unobserved unconditional forecast to the private sector's observed unconditional forecast. So the Fed is making a forecast that it would be unconditional on the policy path implicitly, and we're going to try to use IV to uncover this. The second thing we're going to do is we're going to partition the sample into forecast origins and horizons where the market sort of knows the conditioning path. And we're going to define a sense of knowledge of the conditioning path where the information is going to be sort of equivalent to the Fed's by construction. And then the forecast performance under that situation when the information is equivalent should essentially be the same. So the Fed should not encompass private sector forecasts once we look at periods where the information sets are essentially the same. And in that case, we can use a conventional encompassing test for those periods. And what we would expect to find is that during periods in which they have the same information that the Fed would not encompass, but in periods where the market does not know the conditioning path, then the Fed would have an informational advantage and would encompass in a conventional encompassing test. Okay, so what do we learn? Well, so without correcting for conditioning, the Green Book forecasts encompass the blue chip forecast. That's pretty widely known. It goes back even before, but primarily to the Romer and Rover paper in the AER 2000, and then has been studied a bunch since then. So after we use this conditioning using IV, right? We account for the conditioning path using IV in the encompassing tests. And the Green Book no longer encompasses the blue chip. Okay, so in this case, what's happening is we argue that once you compare the unconditional forecasts from the Fed to the unconditional forecasts of the blue chip, then you no longer see an informational advantage. And that suggests that if I equalize the information set by essentially taking away the forecast, the conditioning knowledge of the conditioning path for the Fed, it will eliminate the Fed's forecast advantage. So that sort of suggests where the Fed's information advantage is coming from. Okay, so moreover, when the market knows the path, right? So when the market has knowledge of what the Fed's going to do in the future, then they have the same knowledge as the Fed, and so the Fed doesn't encompass in a conventional encompassing test there. So that leads us to conclude that the majority of the Fed's forecasting advantage is coming from its knowledge of the path. So once I account for the knowledge of the path, then the informational advantage is essentially zero. And then we're going to think about some implications of this result, macro implications of this result, but we're still sort of working. Okay, so here's the data. The data are forecasts, private sector forecasts from the blue chip and the SPF, and forecasts from the green book. They're made at varying frequencies. Okay, so for various different horizons. The SPF forecasts, which are publicly available, are made at a lower frequency. They're made quarterly, and this creates sort of timing issues with the green book, because what we want to do is we want to give them as close to the same information set as possible. So we want the SPF and the green books to come out essentially at the same time. And because the SPF is quarterly, making them time out correctly is kind of difficult. So what we're going to do is use the blue chip forecasts, which have monthly forecast origins, and so we can better match the blue chip to the green book. Now the blue chip also, I don't think it has as long a sample, and there are some issues with all of this data, but we're going to try to make it as close as possible. So the forecasted variables that we're going to use are GNP, GDP, inflation, and the unemployment rate. We're going to focus on inflation for this talk, and then which is a combination of the deflator, CPI, and PCE over time. It's changed for some of this stuff. And the realizations we're going to use for the data are going to be first final. So the third revision, second revision. Okay, so encompassing. So given the Fed's forecast, encompassing means that the blue chip would provide no additional information. That would mean that the Fed's forecast encompassed the blue chip. So to formalize that, we would run a regression of the H period ahead inflation rate on the two forecasts and a constant. And we're going to test the null that the Fed, the coefficient on the Fed's forecast is 1, and the coefficient on the private sector forecast, so the notation is different there, sorry about that, is 0. Okay, so the Green Book forecasts are constructed, though, using this sort of hypothetical path, this conditioning path. So in the history, after about 1994, when the Fed became more transparent, it became sort of easier to understand what the future path was, so that if the Fed's forecast advantage results from knowledge of the path, increased transparency may sort of weaken the encompassing result, and that's what we should see over time. Okay, so the table shows you what's happening for the pre-1994 period, which is essentially the Romer sample, and the post-1994 period, which is essentially the transparency sample that occurs after the Romers conclude their period. Okay, and what you see is that for the many horizons, intermediate horizons in the pre-1994 period, you get the result that the Fed encompasses the blue chip. But the result is much less obvious. There's much less encompassing going on. The Fed does not encompass in the post-1994 period, which suggests that, well, maybe this is true. So this result that's been lingering around the literature, which is that, you know, transparency may have allowed people in the private sector to infer what the Fed's path is, and therefore weaken the forecast advantage, the informational advantage that the Fed has. Okay, so then now their forecasts are closer to the Fed's forecast, but there's, you know, forecasting literature out there that argues that things like inflation are easier to forecast. So maybe it's just that, you know, it just got easier at that period of time, and so no amount of additional forecasters that the Fed would have would be helping them. So what we are going to do is we're going to sort of take this knowledge of the conditioning path a little bit more seriously. So what we want to do in principle is run an encompassing regression with the unconditional forecasts, right? So the Fed's unconditional forecast, not the one that is observed in the Green Book, but a hypothetical unconditional forecast, and then the blue chips forecast. So in this sense, we're going to compare apples to apples. But the problem is that the Fed's unconditional forecast is unobserved. So what we're going to end up having to do is lean on some results in the literature of conditional forecasting, right? And this is where Mike's knowledge base comes in a big way. Okay, so Wagner and Jouis show that the conditional forecast in a linear model, okay, can be essentially broken down into two elements: the sums of the unconditional forecast, right? So the Fed's conditional forecast that we observe is the unconditional forecast, and then a linear combination of deviations from the path. Okay, so what the Fed would have forecasted for the interest rate variable in an unconditional sense, and then what its conditioning path was. Okay, so then what we can do is we can treat this sort of difference in the conditioning path versus what the unconditional path would be, and sort of the innovation to the policy rate equation, which suggests that we can say, well, you know, the unconditional forecast that the Fed would have constructed would be a component of what the Fed's unconditional path would, an unconditional interest rate path would have been. Okay, so we can use IV, and we can use instruments that are correlated with the unconditional path, so it tells us something about what the Fed would have done had it not had the conditioning information, but are uncorrelated with the deviations from between the conditioning path and the unconditional path. Okay, so to do that, we are going to use for inflation, we're going to use the blue chips forecasts for the unemployment rate and the GDP growth rate as instruments, under the sense that these things would be available at time t. They would not be related to what the Fed was doing with its conditioning path, but they would be correlated with the Fed's unconditional forecast for inflation. Okay, so based on the IV regressions, what do we get? Well, what we get is we get a lot more rejections of encompassing, and so at most of these horizons, you can kind of reject encompassing at least a 5%, and even in the pre-94 period. So you're still rejecting encompassing in the post-94 period, but in the pre-94 period, you get a lot more rejections of encompassing, which suggests that if you equalize their information sets via the knowledge of the path, that you get something that looks sort of more equal in terms of forecast. So it's suggestive that the informational advantage is coming from the knowledge of the path. Okay, so we're going to try to take this even a bit further. The IV result is suggestive. Okay, the information sets are equal in an air quote kind of way. The private sector appears to forecast basically as well as the Fed, so at least the Fed doesn't have dominating information over the private sector. So to try to nail down this interpretation, what we're going to do is identify periods when the market sort of knows the path in an air quote sense, right? So in this case, what we're going to do is we're going to sort of separately test that the Fed encompasses when the private sector does not know what the path is, conditioning path. And then the Fed should also not encompass when the private sector does know the conditioning path, right? So if they have the same information, then you should not find an encompassing result. And the Fed should only really encompass in the forecast sense if the private sector doesn't know what the future path is going to be. Okay, so we have to then spend some time thinking about what does it mean for the private sector to know the path. And we're going to consider two aspects of this. So one is, does the market path coincide with the actual path, the realized path? So is the market getting it right? And the second is do forecasters have a threshold level of certainty? So I have to be both right about the path, and I have to be relatively certain in order to equate to knowledge of the path. So what we're going to do is that we're going to use the short rate that's implied by Eurodollar futures at various horizons to measure what the market path is. And then we're going to compare that proposed path to the actual path, the realized path, to decide whether or not the market knew the path. And then we're going to use the monetary policy uncertainty index from Baker, Bloom, and Davis to measure uncertainty. So, but you know, below a threshold level of uncertainty, they have some understanding. Okay. So
Mike, I'm going to break in and just give you the 5-minute warning.
Okay. At each forecast origin, we're going to compute the expected short rate for various forecast horizons. We're going to compare these implied rates to the actual rates, and then we're going to allow some tolerance. So in this case, if the actual realization of the interest rate is within some band that increases over the forecast horizon, so at very short horizons, say within 5 basis points, but at longer horizons, it sort of increases over horizons, then we're going to say that the market sort of knew what the path was. And then once you're below the 60th percentile for the MPU, we're going to assume that means certainty, okay? So we're going to interact these two things, this on the path measure with this certainty measure, to generate basically an indicator of whether or not the market knew the path, which is going to allow us to partition the forecast origins and horizons into 2 different sets so that we can evaluate these two differently. And this is what you find. So we have fewer horizons in this test, but that's okay. So if the market is either off the path or uncertain, okay, then for horizons 1 or greater, the Fed encompasses. Okay, so the Fed has superior knowledge if the market doesn't know what's going on, and the Fed does, right? So the Fed is basically setting a conditioning path. The market doesn't know what that path is, and then that difference in knowledge makes the Fed encompass the private sector forecasts. In the case where the market does know the path and is certain, there is no encompassing. Okay, so you can reject encompassing for all horizons greater than 1. We sort of discount horizon 0 because at that point monetary policy is a bit baked in. Okay, so that leads us to the conclusion that that the Fed's informational advantage is actually its knowledge of the path, because when the private sector knows what the path is, they're basically on equal information footing. Okay. So then there's some macro implications. We want to sort of think about that. It's true sort of at a cross-sectional, like in a consensus forecast. We looked at the individual level forecasts. Even though the blue chip forecasts are sort of made each month, their horizons can be, the individual blue chip forecast horizons can be funny. They only make 2 forecasts, the current year and the next year. So these horizons are sort of deterministically related to what month of the year the survey is taken. The SPF is available at a lower frequency, but more standard horizons. And we don't need to, for this kind of exercise, we don't need to match the forecast origins with the Green Book as much. So what do we find here? So these are the ratios between on the path and off the path. So a ratio of on the path to off the path less than 1 suggests that the forecasters are doing better when they know the path. And so that's pretty much true for most of the forecasters. So for these 4 horizons, the individual forecasters do better when the market is on the path than when the market is off the path. And and now none of these forecasters necessarily have to be quadratic loss forecasting. Different things can happen at an individual forecaster level, but sort of suggestive that the bulk of them do better when they know what the path is. So we're still working a bit on the macro implications. We have some ideas that there's forecast have implications for things like the central bank Fed information effect, et cetera. So there's some issues there that we're still working on if people have any suggestions. So what the Fed does, it appears to have a forecasting advantage, and we test the hypothesis that the Fed's forecasting advantage arises from its knowledge. And we use two different tests to show that sort of at relevant horizons, not at the zero horizon, but at intermediate horizons where monetary policy might have an effect, that equalizing knowledge of the path negates the forecast advantage. It may have implications for things like identification of shocks or the optimal transparency and then macro variables and volatility. So how well does the private sector do when they understand what the Fed is doing? And so what should the Fed try to do in terms of how transparent it is so that it can telegraph to the market what exactly is happening. Okay, that's what I have.
Thanks, Mike. Right on time. So we have time for questions for Mike. There is one in the chat, Mike, from one of the audience. But if any of the panelists have any
omega T, the intermeeting news, the same over both time periods? The nature of it. So omega T over time could be changing. Omega T between the Fed and the private sector, we assume it's the same. In the Romer paper, they argue that omega T for the Fed and omega T for the private sector at a particular T might be different, and they do some timing information set timing difference exercises to rule that out. So the answer to your question, I think, is that it may change over time, but the relevant question is for the paper, I think, is whether or not it's different across the two bodies at the same time. And in that case, Romer and Romer argue that it isn't. So we're going on that assumption.
There's another question in the chat from Klodiana. Mike?
In the chat. Okay. Green Book have a hypothetical path of policy. Do we know if this is the hypothetical? It is the, so actually Dave probably has more to say about this than I do. It is it's, I guess you would consider it the staff path, but I think it is sort of vetted, I think. Maybe Eric, do you have some, it's not an individual governor path. It's not the path of a particular policymaker, but I think it's.
So in the Green Book, historically, it's an assumption that was made by the research director of research and statistics at the board, that and it is biased toward a constant interest rate kind of baseline. So he would try to assume, a constant interest rate path if possible. But if that seemed unrealistic, then he would build in some rate hikes or rate cuts, depending on the situation.
So the answer is it's staff. It's not.
It's a staff. It's kind of a forecast, but with a bias towards being a flat interest rate forecast.
Because it means that this path is the correct path. It turns out to be if the forecasts are good with this path.
So we can partition also into periods in which the Green Book path is the true path, and then the market gets the path, and so that would be equal information. Mm-hmm. And periods in which the Green Book gets the path, but the market fails to get the path, that would be superior Fed information. Mm-hmm. And there are some periods in which They both missed the path. So that's kind of similar to equal information. And then there's periods where the market gets the path and the green doesn't. That doesn't happen very often. So that's actually reasonably rare, which I guess is good for us in a sense, but or good for somebody in a sense.
So I have a question as well, which is that when I've looked at this with co-authors, we've tended to find the Volcker disinflation is very, very important for these kinds of results. Like, it does seem like the private sector did not understand how determined the Volcker Fed would be to bring inflation down. And so this matters for inflation in particular. The Fed was just much better at forecasting inflation in 1984 and 83, 84, than the market was. And so all of your results that you presented are kind of consistent with that, right? The post-94 results, the Fed has less of an advantage. Pre-94, there's more of an advantage. When you do the on the path, off the path analysis, I mean, it might be the Fed did a better job forecasting in 83, 84 that it was going to raise interest rates really high and keep them there. And so I was wondering, just have you looked at the Volcker disinflation in particular?
We could omit the Volcker disinflation and see how that changed results. That would be relatively easy to do. Sit with that. So
why don't we stop there, just so we can stay on time. And thanks, Mike and Eric. You want to grab your slides and put them up there?
Sure.
So Eric Swanson will be presenting measuring the effect of Federal Reserve policy, the effect of Federal Reserve forward guidance on asset purchases. I butchered the title there. Measuring, it's right there. Measuring the effects of Federal Reserve forward guidance and asset purchases on financial markets. So Eric, the floor is yours.
Everyone can see my screen and hear me, right?
Yes.
Okay. So I won't spend much time on background and motivation given our audience, but during the financial crisis, the Fed pursued two main types of unconventional monetary policy, which I'll focus on. That is forward guidance, which I put in red, and large-scale asset purchases, which I highlighted in blue. Here's an example of the FOMC statement on March 18th, 2009. I highlighted the forward guidance part of the statement in red here. They said they'd keep the funds rate near zero for an extended period of time. And I highlighted the asset purchases in blue. They said they'd buy hundreds of billions of dollars of mortgage-backed securities and GSE debt and long-term treasury bonds. And so you'll notice that statement is not unique. There's many statements where they gave examples of forward guidance or asset purchases or both. Okay, and throughout this period, there's lots of these examples. So the questions that I'll ask in this paper, first of all, was unconventional monetary policy effective? Did forward guidance and asset purchases seem to work? And in particular, which types seem to work better? So that when we're at the zero bound again, like we are now, should we focus on one or the other of these policies? And then a third question I'll focus on, especially at the end today, is did the effects last? I will show you that the effects had, that there were significant effects on impact, but we want to know if those lasted for many months or if they died out relatively quickly, and I'll give you some estimates of that. And then in the background, there's this bigger picture question that if unconventional monetary policy does not work very well, then that means the zero lower bound is a very significant constraint on the central bank. And as a result, the central bank should maybe target a higher level of inflation so that they don't hit the zero lower bound as frequently in the future. On the other hand, if unconventional monetary policy works very well, then the zero lower bound is not that big of a deal anymore, and then the Fed wouldn't have to target a higher level of inflation. Okay, so we'll look at that question. So now the main difficulties I'll face in this analysis is that it's difficult to disentangle the effects of forward guidance from the effects of the asset purchases in the data. Many of those FOMC announcements have elements of both. There's red elements and blue elements at the same time. And so how do you separate the effects of the two? Even in those cases wherein a statement seems to focus on asset purchases, so maybe the statement only looks blue, One of the ways asset purchases could affect the economy is through a signaling channel. It signals that the Fed is very committed to keep interest rates low for a long time. So maybe the asset purchases, maybe they don't have an effect of their own. Maybe all they do is reinforce the forward guidance. So even in that case, you can imagine sort of this effect of asset purchases and forward guidance might be all tangled up because one is very dependent on the effects of the other. And then finally, a third difficulty is that financial markets are forward-looking. If the Fed does what financial markets expect them to do, then there would be relatively little market response. You know, the markets only respond to the surprise component of the Fed announcement. And we don't have very good information or estimates of what the markets expected the Fed to do for asset purchases, for example. And so I'll have to try to get around that using some other market-based measure of expectations, which I'll show you. So in this paper, I'll extend the methods of some earlier work I did with Refet Gurkaynak and Brian Sack in 2005. I'll use those methods, those extended methods, to separately identify the federal funds rate surprise, the surprise change in forward guidance, and the surprise change in the Fed's asset purchases. I'll do that for every FOMC announcement from July 1991 to June 2019. That's the hard part. I'll spend most of my time doing that. Once I've identified those, now I have some data that I can use, and I can run simple high-frequency OLS regressions around those FOMC announcements to estimate what are the effects of those FOMC announcement types on exchange rates, on stock prices, on the Treasury yield curve, on corporate bonds, etc. Okay. And then I'll also look at different subsamples. I can look at the pre-zero lower bound period, the ZLB period, and the post-ZLB period. And I can look at how persistent these effects are. Do they last over time? Okay, so let's talk about the methods. So I'm going to look at every FOMC announcement from July 1991 to June 2019. There are 241 FOMC announcements over this period. And I'm going to look at the 30-minute response of 8 different points along the yield curve to those FOMC announcements. Okay, so I'll look at the very short end, the current federal funds rate, all the way out to the 10-year Treasury yield response. And I'm going to collect those very high frequency responses into a matrix of data, which has 241 rows, one for each FOMC announcement, and 8 columns, one for each point along the yield curve. And I'll call that matrix of high frequency asset price responses X. And so now I'm going to take that matrix of asset price responses X, and I'm going to use a factor model to describe it. So the idea is that these responses X have a relatively small number of factors that are driving them. So if you thought that the change in the federal funds rate was the whole story, that would be like a one-dimensional factor model. There would be one latent factor here, which would basically be like the change in the federal funds rate. This lambda matrix would describe how do those 8 different points along the yield curve all respond to the change in the federal funds rate. And then that factor model would never fit perfectly. There would always be some residual movements that we would chalk up to some white noise epsilon, okay? More generally, you might imagine there's 2 or 3 or even more dimensions of FOMC announcements. So this F could be a matrix that might have 2 or 3 or 4 columns corresponding to the 2 or 3 or 4 necessary dimensions of FOMC announcements that you need to explain how the yield curve responds. So there is a test you can do for the number of factors in a factor model. And so I'll apply that test here. It's this Cragg and Donald test from 1997. You can test whether 0 factor seems to explain the data well. In other words, do these asset price responses just look like white noise? You can reject that extremely strongly. Obviously, these asset prices along the yield curve respond systematically to FOMC announcements. They don't respond in a random manner. You can ask if there's one dimension that explains how those asset prices respond. And again, you can reject that very, very strongly. There's more than going on than just say the surprise change in the federal funds rate. In fact, you can even reject 2 dimensions of monetary policy around FOMC announcements, but 3 dimensions of monetary policy seems to explain the data pretty well, okay, at least in those 30-minute windows around FOMC announcements. So I'm going to, for the rest of the talk, focus on a 3-factor model of what's going on in these FOMC announcements. So there it is, right? I'm going to think there's 3 latent factors here, and I'm going to try to estimate what those 3 latent factors are. Now, there is an identification problem. that suppose U is any 3x3 orthogonal matrix. Suppose I estimate some factors F that I think are the true latent factors driving everything, but then U is any 3x3 orthogonal matrix. If I just define F tilde equals F times U prime and lambda tilde equals U times lambda, then I have an exactly equivalent factor model that fits the data exactly as well as the original proposed model. Okay, so there's an identification problem. I'm going to need to make some assumptions to uniquely pin down exactly the factors F that I think that would not be rotatable. Okay, so how can I do that? By making some additional identifying assumptions. So I'll first estimate three candidate factors F that fit the data X very well using principal components. So these are going to explain the maximal degree of variation in the yield curve X around FOMC announcements. Okay, so together they explain about 96 or 97% of the variation in the yield curve. And then I'm going to look for a rotation matrix U that makes those three candidate factors look like the surprise change in the federal funds rate for the first one, the surprise change in forward guidance for the second one, and the surprise change in asset purchases for the third one, because that's what I think are the three things that are probably driving the market response to FOMC announcements the most during this period. Okay, and so here are these three identifying assumptions that will uniquely identify these factors. So first, I'll assume that asset purchases have no effect on the current federal funds rate. The idea is that the FOMC was mostly doing these asset purchases from 2009 to 2015, when the federal funds rate was basically zero the whole time, so there's basically no effect on the current federal funds rate. Second, I'll define forward guidance, that a change in forward guidance will also have no effect on the current federal funds rates. That's another zero restriction. You can think of this one as like a definition of forward guidance, that changes in the federal funds rate will move the yield curve, but forward guidance is something that will move the yield curve without changing the current federal funds rate. So it's kind of like that's what we mean by forward guidance. Okay. And then the third and final identifying assumption, that I only need three restrictions to uniquely identify an orthogonal matrix U, that I'm going to look over all possible candidate rotations U, and I'm going to pick the one that leads to the smallest values for the asset purchase factor before the zero lower bound period from 1991 to 2008. Okay, and the idea is that the Fed wasn't really doing asset purchases back in the pre-zero lower bound period, so we shouldn't really find much of a role for that factor in the pre-zero lower bound period. So that's not a zero restriction, but it is an additional restriction that will then finally pin down a unique candidate matrix of factors F. Okay, so I'll impose those three identifying assumptions. Right, I'll take principal components, then I'll impose those identifying assumptions, and here's what I get out of that. Okay, and so just checking, right, I estimate that a 1 standard deviation change in the federal funds rate has these effects on these different points along the yield curve, and the units here are in basis points per standard deviation change in the monetary policy instrument. ED here stands for Eurodollar futures. FFR is the current federal funds rate. So a 1 standard deviation change in the federal funds rate is about 8.4 basis points, and then it has sort of a gradually diminishing effect as you look farther out the yield curve. The change in forward guidance, a 1 standard deviation change in forward guidance, has a 0 basis point effect on the federal funds rate by assumption. That was an identifying assumption. And then it has sort of a hump-shaped effect on the rest of the yield curve with a peak right around a 1-year maturity or so, okay, right at the 4-quarter ahead Eurodollar future. And then the change in asset purchases, a 1 standard deviation increase in asset purchases, has a 0 basis point effect on the current federal funds rate by assumption. That was an identifying assumption. It has some small positive effects at the short end of the yield curve. Those turn out not to be statistically significant, I'll show you. And then it has some large negative effects at the very long end of the yield curve. Okay, so these three factors of monetary policy, they seem to be matching what we would expect. They all do look different. So asset purchases do seem to have effects that are not completely dependent on forward guidance implications. And it looks like both of these policies were effective. In fact, you can argue that all three of these policies were roughly equally effective in the sense that they have similar magnitudes across the yield curve, right? So, okay, each of these policies affects different points along the yield curve, but the magnitudes are not dramatically different. Okay, so all of these policies seem to work, and to some extent, they all seem to work, reasonably, with reasonably equal magnitudes. Okay, forward guidance and asset purchases had substantially different effects. And the change in the 2-year Treasury yield is not a sufficient statistic. Some people sort of look at the 2-year Treasury yield as the baseline, but you might be missing some important differences across these policies, right? Asset purchases have very different effects at the long end of the yield curve, whereas the change in the federal funds rate has very different effects at the short end of the yield curve. Okay, so here's a graph over time of what these different announcements look like. So I've estimated here in orange, I'm plotting from 2009 onward here, I'm plotting the asset purchase factor in orange, and here I've multiplied it by -1 so that easings correspond to negative numbers in this figure. And the blue dashed lines correspond to my estimates of the forward guidance factor over this period. And the gray dotted line, which you can hardly see here, it's generally very small, that's the change in the federal funds rate factor over this period. Again, the zero lower bound was binding during most of this period, so the funds rate doesn't move much. And so you can see these factors do seem to line up with what was reported in financial markets and the press at the time, right? The very largest asset purchase factor is on March 18th, 2009. That's the QE1 announcement. So my estimation says that seems to look like a large -5.5 standard deviation change in asset purchases and about a 2 standard deviation easing in forward guidance on that date. You can look at some other dates here towards the end of the sample. The action is mostly in forward guidance, not so much in asset purchases anymore. And again, that seems to correspond to what we were reading about in the Wall Street Journal at the time. Okay, and I give lots of discussion of this in the paper. You can also look at the pre-zero lower bound period. Here, most of the news is about the funds rate and forward guidance. And I won't dwell on that given that we don't have a lot of time. Okay, so that's the hard part, defining these estimating these factors. And so now we can run some simple high frequency OLS regressions of different asset prices on these different monetary policy factors that I've estimated. And so here I've split it up into subsamples. I'll focus in particular for the talk just on the pre-zero lower bound sample here and on the zero lower bound sample here, but in the paper I also look at the post-ZLB period. And you can see here in the pre-zero lower bound period, here's the effects on the yield curve. These are different treasury yields from 6 months out to 30 years. The change in the federal funds rate as its biggest effect at the short end of the yield curve. It's highly statistically significant. These are bootstrap standard errors. There's no question that changing the funds rate has a big effect at the short end of the yield curve, right? And not such a big effect at the long end of the yield curve. Whereas forward guidance has that more traditional hump-shaped effect, right? It seems to have a peak effect right around the 2-year treasury yield. Again, those are all highly statistically significant. And then in the ZLB period, again, asset purchases have insignificant effects at the short end of the yield curve, but large and highly statistically significant negative effects on the longer maturity treasury yields. And forward guidance is pretty similar across both periods. We can look at stock prices. How do those respond? And again, there's pretty significant effects on stock prices in the pre-ZLB period and the ZLB period. Okay, they go in the direction you would expect, right? When the Fed cuts interest rates, stocks tend to rise. When the Fed lowers interest rates, when the Fed raises interest rates, stocks tend to fall. And so all the signs of these coefficients are consistent with that. Looking at exchange rates, right? When the Fed tightens monetary policy, the dollar tends to appreciate, and that's statistically significant. And when the Fed lowers interest rates, the dollar tends to depreciate. And that's true for these asset purchases as well, right? When the Fed buys more assets, interest rates tend to decline and the dollar depreciates. Okay, so this is all consistent with standard views of uncovered interest parity, for instance. And they're all statistically significant and the magnitudes are roughly comparable. Right, so again, suggesting these policies are roughly equally powerful. We can look at corporate bond yields and spreads, and here changes in the federal funds rate have relatively little effect on corporate bonds, but forward guidance has a larger effect, and LSAPs have a very large effect on corporate bonds. Okay. And in the interest of time, let me skip ahead now to persistence. So those are all effects on the day of an FOMC announcement, or even in a narrow 30-minute window. But we want to know if those effects persist for many months, or do they die out after just a couple of days or a couple of weeks. So I'm going to look at whether these effects lasted. Okay, and there's some estimates in the literature that maybe these effects would die out if there's limited arbitrage and it takes time for the arbitrage capital to move and take advantage of changes in risk premium, for instance. Okay. So I'll run regressions looking at H-day changes in yields now. So I'll no longer look at a one-day change in yields. I'll look at an H-day change in yields where H could be 1 day, 2 days, 3 days, all the way out to 90 days. And I'll estimate these coefficients alpha and beta. It turns out the alpha is basically always equal to 0 and the beta is always equal to 1. So in the end, I'll just end up estimating these first difference regressions and I'll regress them on the monetary policy factor. So I'm going to look at H-day changes in yields and how do they respond to those monetary policy factors that I showed you in the previous slides. And I'll present the results to you in graphs that look like this. So this is going to be the effect of the federal funds rate, a surprise change in the federal funds rate on the 6-month treasury yield. And here I put on the horizontal axis the horizon. Is it the 1-day change in the treasury yield, the 2-day change, or the 60-day change, or the 100-day change, or the 120-day change? These are business days. So this is about a 6-month horizon when you go out 120 business days. And so you can see here the impact effect, the 1-day change is in blue. The coefficients are in blue, and the standard errors, plus and minus 2 standard error bands, are in red. And so you can see the impact effect of the federal funds rate on the treasury yield is positive and statistically significant, right? So these standard error bands exclude 0, and the effect is about 6 basis points per standard deviation change in the federal funds rate. And you can see that that effect seems to be persistent, right? When the Fed changes the federal funds rate, it does not seem to go back to 0. It seems to last over time. And here in black, I've imposed some structure on these coefficients. Each of these this blue line here is a set of 120 different regressions with 120 different coefficients. The black line says these coefficients should all be related to each other. And I impose that they have some exponentially decaying functional form, that there's some impact effect A, which would be like that. And then I allow that effect to decay out over time at some rate B. And so then we can see, oh, is there a tendency for this to die out over time? And there is no tendency for the effect to die out over time in this particular case, right? You know, the effect seems to be completely persistent. Yes.
5-minute warning there, Eric.
So let's look at now forward guidance. So when the Fed changes forward guidance, here's the first point in this graph is the impact effect, the 1-day change. It's about 4 basis points per standard deviation on the 5-year treasury yield. It's statistically significant because the 2 standard error bands exclude 0. And then you can see here now, maybe there's some tendency to die out over time. It does seem to go down to 0 for a little bit, but then it widens. But the standard error bands get wider too. But we can estimate the sort of constrained set of coefficients, which impose there's an impact effect, and then the effects have to gradually die out over time. When you estimate that, there is maybe a very slight tendency to die out over time. So maybe there's a half-life here of a year or two, which might make sense for forward guidance. But that decay rate is not statistically significant, and it's relatively small. So forward guidance seems to have persistent effects on the treasury yield curve as well. Okay. Let's look at asset purchases. So here now, again, same thing as before. The first blue point is the impact effect, the 1-day change in the 10-year treasury yield of a change in the asset purchase factor. It's about -7 basis points per standard deviation. It's statistically significant because the plus and minus 2 standard error bands exclude 0. But it does seem to go back to 0 after maybe a month or two. Right? And then it seems to hang out around 0. And so you can estimate this decay rate here. And now the decay rate is much stronger. The half-life here is, I think, maybe 2 months. So there does seem to be much more of a tendency for the effective asset purchases to die out over time. It is not actually statistically significant because these standard error bands seem to be so wide. Okay, so when you although the decay is there, it's not really statistically significant. Part of the reason for that is because that decay is actually driven by one observation in particular. Here it is. It's that March 18th, 2009 QE1 announcement by the Fed again. On that announcement, there's a huge drop in the 5 and the 10-year treasury yields on impact. This is a graph over time. And then as the economy starts to pick up, if you remember, March 2009 is kind of the depths of the crisis. And after that, the stock market starts to recover. People begin to become more optimistic that the economy is going to bounce its way back from this crisis. The Fed releases stress tests, and those are better than people expected. The 10-year and 5-year Treasury gradually rise and rise. In fact, they go up even higher than they started this period at. Okay, so you might think that maybe this died out because the asset purchase was not was just had only transitory effects, or maybe these yields went up for other reasons, like the economy bottomed out and maybe the economy was starting to get better. So you can reanalyze these effects by dropping that one observation. And so here I repeat the analysis. I drop that one very influential observation. Here, here's the effect of asset purchases now, excluding that one observation. It's negative. It's only minus 2.5 basis points per standard deviation now, but it is statistically significant on impact. And now that seems like there's no tendency for the effects to die out over time, right? So it's, that one announcement was very influential, but if you exclude that announcement, asset purchases do seem to work, and they do seem to be perfectly persistent. So I'm about out of time, so I'll just summarize that unconventional monetary policy did seem to be effective. Both forward guidance and asset purchases seem to be effective, and they seem to be roughly equally effective to changes in the federal funds rate in normal times. The magnitudes were all kind of similar. Okay, the effects of both policies seem to be very persistent. There is an exception. That very large QE1 announcement did have transitory effects. That might be for special reasons. It's hard to say. But other than that, the effects of asset purchases did seem to be persistent. And in future work, I'd like to estimate these effects on macro variables. In fact, there's some estimates coming out of the board right now by Thomas Laubach and Min Wei, where they've actually started doing some of those estimates already. So I'll stop there if there's any questions.
All right, thank you, Eric. Any questions for Eric?
I have a question. Just in terms of how you're identifying in normal times these forward guidance and asset purchase factors, given that, if you look at the effect of I think the forward guidance in the pre-zero lower bound, we had large and significant, statistically significant effects. Well, were we really using a lot of forward guidance in that time? Is that factor clearly identified?
Yeah, so the Fed actually did do a lot of forward guidance in 2002, 2003, 2004. And in fact, my earlier paper with Refecker, Koenig, and Brian Sack was really all about that period. That, the Fed introduced, it was doing some minor forward guidance in, 99, 2000, 2001, and it really ramped it up in 2002, 3, 4. And so you can see that in those estimates I have here. And in our earlier 2005 paper, we show that actually forward guidance was a big part of the story, in the 2000s. So okay. The forward guidance part, those estimates are large and very plausible.
Any other questions for Eric? All right, thank you very much. So
stop sharing.
Stop sharing, and Laura, you want to bring up? Okay, so this is a joint paper that Laura Jackson, Mike Owyang, and I are working on. And I'm just going to give a very brief introduction and then hand it off to Laura, who's really been doing all of the work on the paper. So she's going to do the lion's share of the presentation. The usual Fed disclaimer applies. This is our own views. So Laura, you want to bring up the first slide, and then I'll just talk a little bit about the introduction, and then hand it back off to you. So this is a paper that's in the spirit of trying to figure out how to interpret or model monetary policy in a world in which either the primary policy instrument is constrained, such as the federal funds rate being constrained at the zero lower bound, or in the case where the policymaker is using multiple instruments. As Eric's paper just showed, we have, in the case of the United States, in recent years, evidence that the Fed has had multiple instruments, not only the funds rate, but the Fed has used forward guidance and asset purchases, particularly when the primary instrument, the funds rate, is at zero. So we're working in a small but growing literature associated with the shadow funds rate estimation, thinking of papers that use the yield curve modeling, such as the papers by Krippner and Wu and Zha, and more broadly, the factor augmented VAR type work, such as the paper by Lombardi and Zhu, which takes a broader set of factors, principally the Fed balance sheet, into consideration. So I'm interested in this topic not only because it's relevant for the zero lower bound period, but for earlier eras when the Fed either wasn't targeting the federal funds rate per se, or it was using multiple instruments. So the funds rate really has been the Fed's primary instrument only since 1989. And for earlier eras, the Fed had other measures, often more quantity-based measures. Famously, during the 79-82 Volcker disinflation, the Fed was targeting non-borrowed reserves. But then there were other periods, such as the 1970s, when the Fed had multiple instruments. In that era, the Fed was targeting the federal funds rate, but also measures of the broader money supply, M1, M2, and so forth. Of course, there's a long literature that was in that era of trying to come up with a composite measure of monetary policy. And that's an old problem. And there are different ways that people have attempted to address this historically. Friedman and Schwartz famously estimated the measures of the money stock, broad and narrow, in their monetary history of the United States, and subsequent books on monetary aggregates. And another strand of that literature, I think pioneered with Carl Brunner in 1961, where he developed a measure of the monetary base that was adjusted for changes in reserve requirements, is a sufficient statistic to capture the thrust of monetary policy. Others have taken different approaches, looking at various measures of money market conditions. Paper by Anderson and Rash looked at that era. And then, of course, there's the narrative approach, famously associated with the Romers and Boshin and Mills. So in this paper, we're taking a broader measure, or a broader historical focus here. An interest of mine for longstanding is the Great Depression of the 1930s. And of course, there's a long history there of trying to interpret the Great Depression in terms of monetary policy. And just a very basic question: was monetary policy tight or not so tight during the Great Depression? And that's a question that we hope to look at with what we're doing. So basically, we're coming up with a new composite policy measure derived from a factor augmented VAR with time varying loadings. So Laura is going to explain exactly what we do and how we differ from other approaches, and then present some results for the last 60 plus years. But we ultimately hope to push this back to the Great Depression period and look at the evolution of monetary policy in the index at different points in the Fed's history. So Laura, let me pass the baton on to you. I'll shut up, and the floor is yours.
Okay, great. Thanks, Dave, for that introduction. So to kind of think about our approach in this model, we're, like he said, trying to build an empirical model where we're summarizing monetary policy with just a single latent series. And so our assumption is that when you're properly measuring monetary policy, the effects on the economy are linear. However, the stance of policy itself is a cumulative accumulation of a number of different measures that potentially could have time varying weights. And so this we would start to become important throughout the history that Dave was mentioning, in which the Fed clearly was using different aggregates in terms of targeting reserves or targeting the Fed funds rate, and then more recently the introduction of things like forward guidance and asset purchases. So we do find ourselves, very fitting in this session, I think, given the other factor model approach, and then the, Eric's paper in particular, kind of utilizing or identifying these separately, where we're basically kind of combining those all into one stance, where the weight attributed to forward guidance or asset purchases or these other different aggregates could be changing over time. So in general, our approach is very similar, like Dave said, to models of the shadow rate, and that we're using a factor structure. We're kind of combining a variety of instruments to get this single series. However, our latent variable doesn't necessarily converge to the Fed funds rate during normal times when we're not facing the effective lower bound. And the reason being is that we're explicitly incorporating the effects of these other aggregates or these other potential policy instruments, and allow the weight to depend upon the importance placed on those instruments over time. So in periods in which there was lesser importance placed upon the Fed funds rate because of the constraint of the effective lower bound, these other policy instruments would then start to become more important. So also, I guess, deviating a bit from the approaches in the shadow rate models is that our data set includes these other instruments explicitly incorporating measures of the money supply, the monetary base, discount rate, and so forth. And we're allowing these weights to vary over time. And in some cases, the weight on a given instrument may be small or negligible. And so those would be periods in which this kind of motivated my question before, periods where maybe these asset purchases, either did not exist or were not being used actively, the weight placed upon that particular instrument in that period in time could go towards zero. So if we think about the factor augmented VAR, oh, did I skip here? I think I skipped. No, okay. And so in a typical factor model, the relationship between the unobserved factors and the observable factors is stable over time. And so here, this is that loading connecting the observable series to this latent unobserved series, and that loading is constant in the typical factor model. And then the Del Negro and Otrock in 2008 proposed an alternative in which the factor loadings could evolve over time as well. And so our observable series then is now a function of time varying loadings and time varying factors. And so we're going to adopt a similar strategy in which this time variation in the loadings allows us to model that time varying weight in policy instruments. And so when we form the cumulative stance of monetary policy during periods in which the Fed, for example, targets reserves, the loading in terms of importance and relative magnitude in terms of how that contributes to the stance of policy, the loadings on reserve components would then become more influential, and perhaps the loadings on the Fed funds target and that sort of thing would become much less influential. So to get kind of in the specifics of the model, we can think of our two vectors of observable data. This XT would be the policy instruments. So we've got some set of potential policy instruments over time. And then YT, this is where the factor augmented VAR piece comes in. These are the macro aggregates of interest in which we would be modeling the effects of policy. And so in theory, we could have any K number of latent factors in this FT vector. We are assuming only one factor. This is, again, like I said, differentiate from the paper before in which there were 3 factors for policy. We're just kind of accumulating them all into one. And so these YT variables would include the typical macro aggregates, and we think of stuff like output growth, inflation. Where do we want to be able to measure the effects of our policy shocks? So that's the standard monetary VAR there. And so in the factor model framework, our M observable, so we have M potential policy instruments, would be summarized by functions of time varying loadings, lambda t, and time varying factors, this F component here. And so our innovations in ET would be innovations to the different policy instruments. So then what we'll ultimately be able to find is that the innovations to our stance of policy, how we're trying to identify monetary policy shocks explicitly, those would be some combination of the shocks to our different policy instruments. But in the factor model framework, the covariance matrix for these ET, this is diagonal. So we're trying to get, any deterministic or systematic relationship between our policy instruments comes from the factor. We're assuming that our factors can explain, our individual monetary factors capturing the dynamic relationship between the policy instruments themselves. And so that's the measurement equation in our factor model. And so the state equation is really where we're getting a lot of the interesting dynamics. And so here we're looking at combining explaining the relationship between how our factors evolve over time in the context of the macroeconomy, and then how the loadings evolve over time. And so at this point, we're excluding any interaction between the factors and the loadings. So basically separately modeling the dynamic behavior in our loadings, which we see this lambda t component here. These are just evolving as a random walk without drift. So there's a lot of persistence in the loadings, where we assume that the UT innovation has a very small variance. So there's little changes over time, a lot of persistence in these loadings, but they still can change. And in particular, they can change when the Fed's utilizing these policy instruments differently over time. But a lot of the other side in terms of kind of where policy is coming into play in the economy comes in the other component, where the factor augmented VAR models the joint relationship between our Y, macro aggregates, and our F, policy instrument. And so what I want to look at more closely is this bottom right component of the state equation, these B lagged coefficients, and then the covariance matrix linking the epsilon Y, the innovations to our macro variables and the innovations to our policy instrument. So when we're trying to think about how to identify monetary policy in our approach, we face the similar issue as the other factor model presentation, in which kind of like, how do we identify this factor and what this factor is doing in the economy? So we opted to build our strategy around the idea that we know in certain periods what monetary policy should be doing. And so we're taking as given what monetary policy does during an environment in which we know what the Fed is using for its policy instrument. And then once we can, model and clearly describe what monetary policy does, we use the factor structure to identify what is monetary policy. What is the, cumulative stance based upon this vector of potential policy instruments. And so the way in which we go about employing this strategy is that during the period from 1990 to 2005, we're assuming we know that the true instrument of the central bank was the Fed funds rate. The Federal Reserve was the Fed funds rate. This is a reasonable assumption, and that this is a time period in which we know that the Fed was targeting the Fed funds rate. We can model it pretty clearly. We're not facing issues with effective lower bound. We did have other instruments in the toolkit, but this was the primary instrument that was utilized and communicated to the public. So what we do first is we're using monthly data on output growth, inflation, and commodity price inflation. We use the Fed funds rate as our policy instrument and estimate a VAR with data only from 1990 to 2005. So from here, we identify the coefficient matrix, these B components. We identify a variance covariance matrix based upon the innovations in the model. And then when we're estimating the factor model, the dynamic factor model from before, and actually extracting the factors, we're going to set as fixed this structure in which the effective monetary policy is clear and the effective monetary policy is identified in the macroeconomy. So this B component, the lagged coefficients, and our variance covariance matrix are fixed given the 1990 to 2005 period. And then we will employ a filtering mechanism to back out the stance of policy. I say these are fixed, but we do allow for breaks in the covariance matrix, as well as the subcomponents of the BL coefficients related to inflation during price controls. And so periods in which we have price controls, the response of other macro aggregates to inflation could change from our 1990 baseline. The variances could change from what we established in the 1990 baseline, but that's still our starting point, and then we would allow for deviations from there. So how this differs from existing shadow rates. So first, the shadow rates employing the methodology of Black's 1995 paper, commonly, common references now, Krippner and Wusha, as David had mentioned, are imposing that the effects of unconventional policies really come through the term structure, right? So the data that are used in the observable, the measurement equation in their structure are all term structure data. And so this might not really capture the full level of accommodation, in particular if we're looking at, quantitative easing programs that had effects through, purchases of mortgage-backed securities and other assets that had portfolio balancing effects, but maybe didn't surface through long-term treasury yields. Those wouldn't be captured as clearly in the shadow rate models. And so this drawback was identified in the Lombardi and Jouis paper. And so they tried to address this by kind of imposing a structure-free, so no term structure basis. It's simply a dynamic factor model using a really large set of policy data. It was a very kind of similar idea to what we're looking at here, that we're extracting some factor, explaining or encompassing the changes in these various policy instruments. And so what they do in their paper, they're utilizing kind of the historic relationship between how the Fed funds rate and these other instruments behaves over time, and then using that to kind of model what the policy stance would look like during the unconventional period. And the loadings, the connection between their index and therefore the policy instruments are fixed over time. We're further exploiting that historically relationship, but allowing the connection to be time varying. So rather than imposing that these loadings have to be constant and then see what it looks like in the ZLB or effective lower bound time, we allow the connection to change over time based upon which instruments are more important. And then we also have the goal of extending the data set back even further to hopefully encompass the Great Depression. Like we said, right now we're only going back to the 50s. So what our framework allows us to do is to construct or to conduct policy experiments that really kind of exploit changes in these instruments individually. And so the model that we present is different from, how policy might be measured in a factor augmented VAR, or even a time varying factor loading VAR, like the Del Negro and Otrak framework, in that in a typical factor augmented VAR, policy is a component of the VAR with the macro. And so if you think of the Bernanke, Boivin, and Elias approach, we have this big panel of data that we want to measure the response of. We capture an innovation to policy in the VAR and then use the loadings to propagate that out, right? To see kind of how all these other asset prices or other measures, financial market measures, whatever they want to measure the response of. Here, rather than the policy instrument being housed only within the VAR, it's a composite calculation based upon the large panel of policy instruments that we could potentially use. So what we can think about here is conducting an experiment where what if we were to change the policy instrument in X in our measurement equation? So then we would say, for example, change, something in terms of our reserve measure. That would translate into a change in our factor because of how that policy instrument is contributing to F. So we'd change our policy instrument, that changes our factor F, and then within our VAR, that then serves as our policy innovation that would propagate towards output growth, inflation, and we could see how through this structure, changes in the policy instrument then kind of feed into and affect the macroeconomy. So when we want to think about how our policy instruments then affect the factors and therefore the macroeconomy, we again are assuming that the factors, capture a lot of the variation. So we're kind of minimizing anything that's getting thrown into the error. So our factor is really capturing the behavior of the conjunctive, kind of cumulative instrument stance. And then we're conducting similar experiments to previous work. And like I said, we change the factor via whatever we've done in the measurement equation, whatever we've done with our policy instrument. We change our factor, and the link there is the Kalman gain. So we're going to be using a Kalman filter approach here. And so that Kalman gain tells us how we change X, that changes our factor. The innovation to the factor then serves as our policy shock, how we can identify, a shock to at a given point in time. And so while we have a lot of nonlinearities in the model, right, we have lambda t, ft, we've got a lot of changes. At any given point in time, the model is linear. Right? We have a connection via the factor model from the instruments to the factor to output growth and inflation. Okay, so the policy data that we're currently working with, so we have a much larger data set in terms of time than what we're currently using. And right now, the instruments that we include are the Fed funds rate, the discount rate, the 3-month Treasury bill, and you'll note that a lot of these date back to well in advance of the Great Depression. Our ultimate goal is to utilize this entire data set. The 3-month Treasury bill kind of had to slice together a few different series. Our long-term government bond rate is, in order to construct this series, it has been constructed back to 1919, and it's sort of kind of an average of a mixture of long-term government yields. We have a measure of the money stock, non-borrowed and borrowed reserves, a measure of the monetary base. And so our money measures, the M2 and the monetary base, we're looking at flow. So we're looking at year-on-year growth rates, kind of see how changes in the money supply factor in, whereas our measures of the balance sheet are stock. Our measures of the balance sheet are levels. So here we scale them by IP, by nominal IP, but we're putting in the kind of quantitative size of the balance sheet rather than changes in the balance sheet. We're currently using data from January 1954 through May 2020. This starts right after the Korean War price controls. And so we're trying to work through some data and identification issues in that early period. So to be able to utilize the entire sample back to the Great Depression time. But right now we're starting in 1954 and extending through May 2020, which does allow us to capture kind of the unprecedented response that we saw in the March-April period of this year. And so the estimation is fairly straightforward once we utilize the caveats that I had mentioned before. And so we're conditional on our policy instrument data and the macroeconomic data. We have time invariant parameters. The variances in the measurement equation are pretty straightforward to estimate. The omega, the variance covariance matrix, and the VAR coefficients, like I said, we estimate those in a previous exercise in the 1990 to 2005 and impose them. So in the actual model here, really the tricky part comes in extracting the factors and the time varying loading separately. So Dalnegra and Otrok use a sampler in which this is kind of a dual Kalman filter, in which we hold condition on the factor loadings, run a linear Kalman filter to extract the factor, and then conditioning on that estimate of the factor, we run a separate second linear filter to extract the loadings. So we're adopting, that strategy employed through the Scoop and Corbelis paper in 2014, kind of a similar approach here, where it's kind of an iterative process of holding the factors and estimating the loadings and so forth.
5 minutes, Laura.
Thanks. So here is what our policy index looks like. This is the posterior median, and then we've got a 68% to show that it's very clearly estimated. We see a lot of periods in which, the early part of the sample, the early 70s, early 90s, we get pretty easy monetary policy. Our index is mean zero by construction. We can very clearly capture the easing during the financial crisis. And then while we did see some tightening following the financial crisis, it really stayed quite accommodative in comparison to the historical stance of policy. And then we see the substantial easing associated with the very end of our sample. The interesting stuff comes in the dynamics when we're looking at how the factor loadings are changing over time. And so just a couple of points to note as you are looking at these things here. The loadings, the strong emphasis we see on interest rates during the high inflation periods of the 1970s and 80s. You see that the loadings are really large and kind of tracking a lot of the movement in the interest rates themselves. And then even when we're facing the effect of lower bound on interest rates, given the fact that our interest rates fall to zero and then are held there consistently, we do still see that this is contributing a considerable amount to our policy index. So while they stay low, they stay zero, they're still suggesting a substantial level of accommodation. And then we can very clearly see, for example, with non-borrowed and borrowed reserves, periods in which non-borrowed or borrowed reserves get really large in the financial crisis and subsequent period, the loadings get very large and negative. And so this would be suggesting big changes in our balance sheet, driving down this policy index quite dramatically. And so I spent a lot of time explaining how we differentiate from shadow short rates, but it's very good exercise still to see kind of how do we compare in terms of what our policy index would suggest. And so here I'm just plotting the Mushaw and Krippner shadow rates. I scale ours to kind of put it on a scale that we can compare with the two. And as I mentioned, ours is mean zero by construction, so that's why we see our kind of deviations above and below zero. And so, you know, one thing to note, we have a much longer time series, but over the period in which we do overlap, at least kind of prior to the zero lower bound, effective lower bound period, we have very similar behavior to what the shadow short rates would suggest for this cumulative stance of policy. And then if you look specifically at the financial crisis and beyond, when perhaps measures of the term structure would have suggested a somewhat tightened stance of policy, we see these shadow rates are both rising. We still see a pretty substantial level of accommodation. So kind of incorporating the broader effects, allowing for time variation and how these other policy instruments would feed into the index, suggest a much easier level during this entire time since hitting the zero lower bound and then the drastic policy accommodation of earlier this year. So I think I'm just about on time. So just to kind of quickly summarize what we're doing, we're presenting a composite policy measure using a factor augmented VAR and allowing our policy instruments to contribute in a time varying way to our cumulative stance of policy. And this measure is really incorporating a number of different measures, assuming that when we have a proper measure of policy, we get the typical linear effects. So we have a standard model of the macroeconomy, a standard position in which the policy can propagate to output and inflation and so forth, and the effects are linear at a given point in time, but we allow for the dynamics to change. We are taking as given, like I said, we assume we know what policy does and then back out what is policy. So we're kind of utilizing that 1990 to 2005 period, putting a lot of weight on what's going on in that sub period. And then kind of where we're going with this in the future, our plans are to extend and use that full data set to go back to the Great Depression era once we work out some of the issues I had mentioned, and then also add to our data set measures of expectations of future policy. So perhaps if we can get Fed funds futures, stuff like that in there, we can kind of maybe capture how those might come into play. And this perhaps also may bring in more of a role for things like forward guidance in the recent past and current period. So I think I will stop with that, and I'm happy to answer any questions. And like I said, this is still a work in progress, so also open to any suggestions that anyone might have.
Thanks, Laura. Any questions or comments that anyone has?
I have one question.
Sure.
Is there a way to incorporate communication? Now we say that communication is another tool, policy tool. And here we see that you have incorporated usually actions. So is there a way to incorporate communication as well in this set of instruments?
So to be explicitly included, we would need a measure of something like that. I suppose if we were to put together some sort of index, I know you kind of, in terms of identifying the stance of the FOMC and so forth. So if we had quantitative data could go in, I think if we were to incorporate things like expectations, so if we put in Fed funds futures stuff or something more forward-looking, explicitly forward-looking, it might kind of get at that a little bit, and that the communication should in theory affect this futures data. So we would sort of kind of infer the effect of communication through something that we could quantify.
I mean, that was similar to a question I had, that you do have the 1-year treasury bill in there, which is going to capture some of that forward guidance, but you could consider putting in a 2-year treasury yield maybe, which would maybe capture a little more, or a 4-quarter ahead Eurodollar future. But then are you capturing asset purchases at all? I mean, do those, you're not looking at the 10-year treasury yield or anything, but you are looking at reserves. And so do asset purchases show up in reserves? Is that how they would be captured?
Yes, so the balance sheet measures would come through the reserve pieces. The long-term government bond series that we're using isn't explicitly the 10-year, it's a kind of an average of, okay, yeah, right. So it's coming through there.
Yeah.
Yes.
I forgot that. Okay. So you mentioned you have problems extending this back. So what are what goes wrong when you start to go into the 1940s or the 19?
Well, so just in that period, the parts of the model that we do have fixed seem to not want to be fixed in the early part of the period. And so when we're trying to kind of identify the loading and the factor, we don't get very clear identification in that if you were to couch this in the same model when we're looking at, the last 30 years. So we just need to kind of disentangle where the nonlinearity might be coming in there too.
Yeah, and some of it's just practical, splicing together series that are not necessarily perfectly consistent with one another. And then, get the Korean War period and World War II, you've got price controls going on. And of course, the data generating process is going to be very different during the war. So it's complicated. But.
That makes it hard. Okay. And you could try to dummy out the wars and just exclude them and,
Right.
You could focus on the 20s and the 30s, although the Great Depression itself is difficult. But.
All right, I think I've got a warning from the host that they're going to turn us off. So I really appreciate everyone participating in the session, especially our speakers, Klodiana and Eric, as well as Mike and Laura. So really very happy with how the session worked, and unfortunately the technology held up. Even Mike Owyang's technology was somehow managed. So thanks very much, and I'll declare the session concluded. Thanks again.
Thank you.
Thank you.
Thank you.
Take care.
Everyone.